Welcome back to FedSpeak, the show where we break down the latest economic research so you can understand what's really happening with your money. Today, we're diving deep into a topic that hit millions of Americans square in the wallet last year, the restart of federal student loan payments. After a 3-year pandemic pause, roughly 40 million people suddenly faced a new monthly bill. The big question, the one everyone was asking, was how would this impact household spending? And more importantly, how would it affect the broader economy? Well, new research from the Fed's notes is shedding a bright light on this, and the findings are not just significant, they're frankly a little surprising. It turns out people started cutting back on spending even before they had to make their first payment. Stick around, because this has major implications for what's next. This fascinating new research note from the Feds, titled Debt Payments and Spending, Evidence from the 2023 Student Loan Payment Restart, uses a unique natural experiment and incredibly granular data to understand this link. The authors, Aditya Aladengadi, Edmund Crawley, William Gomber, Patrick Moran, and Jose Nino, wanted to see how changes in student loan payments and interest accrual affected household spending, and they found a clear, measurable impact. To do this, they used a massive data set, combining zip code by week transaction data from Veris Commerce Signal's spend tracker, which covers 55 million individuals and $800 billion in annual sales. They then linked this with federal student loan balances from the Federal Reserve Bank of New York/Equifax Consumer Credit Panel, along with detailed demographic and income information from the American Community Survey and IRS Statistics of Income. Now, before we get to the findings, let's look at the robust data this research is built on. Table 1. Sample Summary Statistics gives us a snapshot of the main demographic variables and the student loan levels per capita across the zip codes in their sample. You can see the wide range, from a minimum of 0 to a maximum of over $30,000 in student loan levels per capita, with a mean around $4,300. It also shows the distribution of income, education levels, and population figures, highlighting the diverse landscape captured by this study. It's crucial to understand who these borrowers are and where they live. Specifically shows that zip codes with higher student loan balances per capita tend to have a higher fraction of college-educated workers and higher average incomes. The research also shows these areas often have a higher share of young workers and, interestingly, a lower fraction of subprime borrowers, except in regions with the highest college shares. This correlation is why the researchers had to carefully control for these demographic and income differences in their statistical model. The core of their findings is revealed in Figure 2, Dynamic Response of Student Debt on Spending. This chart plots the causal effect of an extra $10,000 of student loan debt on consumer spending over time, from January 2022 through April 2024. What's striking is the flat line before June 2023. This indicates no significant differential pre-trends between areas with more or less student debt, which is crucial for validating their causal interpretation. But then, following the announcement in June 2023 that payments would resume, we see a gradual, though persistent, decline in consumer spending. This decline accelerates further after October 2023, when payments actually restarted. It's clear people started cutting back even before the first bill was due, and then even more once they were required to pay. To quantify this, Figure 3, Average Response of Student Debt on Spending, breaks down the average weekly impact. It shows that in the post-announcement period, that's between the June announcement and the October restart, households reduced their spending by about $620 per $10,000 of student loan debt. This is what the researchers call an anticipatory effect. Then, in the period after payments officially resumed in October, that cutback nearly doubled, reaching $1,220 per $10,000 of debt. This anticipatory effect is a key takeaway. People reacted proactively, not just passively. The aggregate implications are significant. The researchers estimate that the resumption of student loan payments reduced consumer spending by a massive $80 billion at an annual rate. That's roughly 0.3% of GDP or 0.4% of personal consumption expenditures in Q1 2024. For a median student loan borrower, this translates to an annualized cutback of $1,590, or about $130 per month. Interestingly, this is larger than what earlier surveys predicted, suggesting the real-world impact was more substantial than borrowers initially anticipated. The study concludes that the end of forbearance amounted to a noticeable drag on aggregate demand, implying that student loan forbearance and its removal can have meaningful macroeconomic impacts. So, what does all this mean for us, for the economy, and for investors? Well, first, it confirms what many suspected. The student loan payment pause was a significant boost to consumer spending. Its removal, conversely, acts as a noticeable drag. An $80 billion annualized reduction in consumer spending is not trivial. It's 0.3% of GDP. That money is no longer flowing into retail, restaurants, travel, and other discretionary sectors. For investors, this signals continued headwinds for companies heavily reliant on consumer discretionary spending. Think about sectors like retail, hospitality, entertainment, and even certain durable goods. With an implied marginal propensity to consume, or MPC, of 1 out of these debt payments, it suggests that every dollar freed up by the pause was almost entirely spent, and every dollar now going to payments is almost entirely not being spent elsewhere. This is a very direct and impactful transfer of funds from household spending to debt repayment, and it's something equity analysts need to factor into their earnings models. It also highlights the sensitivity of the economy to consumer balance sheets and policy changes affecting household finances. Given this new data, how might I, as an investor, think about altering my own portfolio or strategy? Well, the anticipatory effect from Figure 3 is particularly telling. It shows that households responded to the announcement. This means economic signals, especially those impacting disposable income, can have a forward-looking impact on consumer behavior. For my own portfolio, I'd certainly be paying closer attention to consumer discretionary sectors, especially those with lower price points or higher exposure to younger demographics who are more likely to hold student debt. This $80 billion drag isn't just a number. It represents reduced demand for goods and services. I'd be scrutinizing earnings reports for any signs of slowing sales or increased promotional activity in these areas. While I'm not suggesting a mass exodus from these sectors, it certainly warrants a more cautious approach and a closer look at companies with stronger balance sheets or less reliance on this segment of consumer spending. Furthermore, this research underscores the importance of monitoring broader consumer sentiment and spending data as a leading indicator, as consumer reactions to policy changes can manifest well before the full impact is felt. This data helps us understand the current economic environment and potential future trends. That's all for FedSpeak today. Thanks for tuning in, and remember to like, subscribe, and hit that notification bell so you don't miss our next deep dive into the numbers shaping our world. See you next time. This is not financial advice. All opinions are for informational and entertainment purposes only. Please consult a professional for your financial decisions.